And if you're actually looking at the 2025 outcome, then what we could see is that Amazon has been able to yet again improve its trade term basis with brands by an average of 91 basis points year over year. Now, this in itself is quite significant, but even paired with the fact that last year, Amazon was able to improve trade terms by 70 basis points. So we're seeing multiple consecutive years where Amazon seemingly improves its overall trade investments with brands, thereby has a direct margin benefit.
Let's talk Marketplace.
The Marketplace podcast with Ingrid Lommer and Valerie Dichtel.
Welcome back to Let's Talk Marketplace. Another time with Valerie and me, but not just with us, but with another returning customer, so to speak, because today's episode is a special one. We welcome a familiar face back to the show. And he's one of Europe's leading experts, I would say, on Amazon vendor strategy. And that's why we always like to call him back when we want to talk about Amazon and how Amazon is dealing its vendors. And yeah, today is one of those episodes. So welcome back to Martin Heubel.
Yeah. Hi, Martin. And we are really happy to have you here again. Martin has worked for Amazon, both in Germany and the UK. Actually, we were formerly colleagues at our both Amazon times. And now he runs his own consultancy, helping first-party vendors navigate negotiations, profitability, and selection strategies, obviously connected with Amazon. And yeah, every time he joins us, we get an insider look at how Amazon really works right now behind the scenes and what that means for brands. Yeah. And I'm really happy that you are here today, Martin, because, I mean, we were both on this vendor manager side on the other table and now changed the table side, and I'm really excited to hear what updates you brought today.
Yeah, hi everyone, and thanks first and foremost for having me back. Very excited. I think, gosh, it's been probably a year or so since my last came onto your show.
About a year, yes. Yeah.
Mm-hmm. Right. Yeah. So lots have changed, obviously on the vendor side of things, on your side as well, as I was just able to hear. And obviously I'm a big fan also of you on LinkedIn, following all of your journey. And I think it's going to be quite an interesting year for a lot of brands, not only because of the geopolitical shifts and macroeconomic shifts that we are seeing probably since the last 6 months or so, but also because of the overall economic uncertainty. And I think we'll be able to unpack most of that, hopefully, today.
Yeah, I remember our last episode together where we were talking about the vendor cleanup when Amazon had kicked out a lot of smaller brands and crap brands who couldn't realize a profit for Amazon. And there was a lot of uncertainty in the whole business about, okay, am I going to be next or not? And you had quite good insights into everything that was going on at that time. So yeah, we're looking forward to another update on that part, but maybe before
today the great Amazon vendor update you wrote, right?
Yes. Yeah, but maybe not everyone has listened to our last episode, so I think we should go into our 3 questions, shouldn't we, Valerie?
Definitely. Yes. So Martin, who are you and what do you do?
Yeah, my name is Martin Heubel, used to work at Amazon for around 5 years between 2016 and 2021 across a variety of different product categories, from home housewares to then also in fast-moving consumer goods. And transitioned then into my role as an independent consultant back in 2021, now assisting vendors to really kind of capture the full potential of their bottom line and helping them to bridge the commercial gap that exists between their realities and also the demands that Amazon constantly makes to manufacturing brands that directly sell and trade via Vendor Central to Amazon. So typically that means I assist them doing the vendor negotiation process, but also find quite creative strategies on how they can secure, protect, and grow their own bottom line with the online retailer.
Mm-hmm. Very good sales pitch, Martin.
Perfect.
No, but it's actually, I can just sign this one. So what would you say do you best when it comes to the marketplace business?
Really helping brands see why retailers like Amazon cannot be treated like a typical kind of offline retail customer, right? I think oftentimes, especially with the wealth of experience that a lot of brands are having in the offline trade and media, they're thinking that they can simply copy and paste their strategies onto the online marketplace retailer Amazon, only to finding out that it is easier said than done. So it's first and foremost really about educating oftentimes senior stakeholders and, okay, what are the actual differences, but then also helping the actual operational sales teams to implement this change and constantly re-educate the internal stakeholders that sit across various divisions, whether it is logistics, finance, right? All of these supporting divisions that have quite a material impact on your total cost to serve Amazon. I think the questions around this online retailer are vast. The answers are usually very shallow, but then really diving deep into, okay, what are the strategies and tactics in order to unearth the margin potential is what I've really kind of focused on with my consulting practice and do on a day in and day out basis.
Mm-hmm.
Okay, yeah. And the final question, the final fun fact question about you, Martin.
Do you have a new one for us?
Okay, a final fun fact question. I like that one. I used to, before I even was at Amazon, intern at a British PR consultancy. And they gave me the very simple task of just sending out an email that was about a news title about Microsoft killing a certain switch, which would have an impact on a lot of tech providers. But when I copy pasted it, I manually interfered. So I sent out a huge email blast to, I think, hundreds of reporters where the title was Microsoft kills which got a lot of excitement, a lot of responses. Was, of course, hugely embarrassing for me, but was one of the email campaigns that got one of the most and highly rated responses from all of the journalists out there.
I can imagine. How often was it printed is the question here.
It wasn't printed.
It wasn't.
I
really
think most
not.
journalists actually captured it.
Yeah, I wouldn't be so sure about that, That's a nice one.
I have to Google it, actually.
Right. Thanks for that, Martin. Yeah, so great to have you back and to have your expertise back on Amazon. So we will dive again into the depth of the vendor business after a very short break and a quick word on our sponsor, MediaMarktSaturn.
Are you ready to take your sales to the next level during Black Week at MediaMarktSaturn? Then don't miss out our upcoming webinar, Black Week Success on MediaMarktSaturn, how to maximize your sales potential.
Join our experts, Nikolaus Volpini de Maestro from the retailer Nero Group and Alexander Klinger from MediaMarktSaturn on October 13th at 2 p.m. for a free and live session. This webinar is perfect for brands in electronics, home and living, DIY, sports and toys, and those who are looking to boost their sales during the Black Week, which is particularly crazy on MediaMarktSaturn.
So here's what you learn. You get insider tips on optimizing your listings, inventory, and running successful campaigns, how to plan for Black Week, ensure availability and leverage bundles to skyrocket your sales, and how sellers can avoid the problems and pitfalls of an incredibly busy Black Week.
It's your chance to get actionable insights from experts and set yourself up for success. So don't miss out this opportunity to master the Black Week. Sign up now and we'll link you the webinar in the show notes. Okay, right, Martin, let's dive into it. Last time we spoke, as I just teased in the beginning, we were talking about the vendor clear-up that Amazon did last year and their very strong profitability focus. So is that still the case this year, or do you see a swing back in another direction from Amazon here?
Yeah, so the longer you are in the Amazon space, the more you typically see Amazon swinging like a pendulum from one into the other direction, right? Mm-hmm. So either they're very much focused on sales growth or they're focused very much on profitability. For anyone who's managing Amazon since the pandemic, you will have seen that Amazon has a very strict focus these days on mostly profit growth, following the significant growth boost that the online retailer has really experienced through the pandemic. Mm-hmm. But if you're looking actually at a data-driven perspective, I do run a biannual kind of research where we look at, okay, what was the outcome of the most recent vendor negotiation cycle? And if you're actually looking at the 2025 outcome, then what we could see is that Amazon has been able to yet again improve its trade term basis with brands by an average of 91 basis points year over year. Now, this in itself is quite significant, but even paired with the fact that last year Amazon was able to improve trade terms by 70 basis points. So we're seeing multiple consecutive years where Amazon seemingly improves its overall trade investments with brands, thereby has a direct margin benefit. And actually half of all vendors, and it were over 180 that participated in the survey earlier this year, saw a negative margin impact to their Amazon margins as a direct result of these vendor negotiations. Now, this is all good and fine because maybe these vendors have been able to save money elsewhere, but they're actually saying, okay, also net, we're seeing a deteriorating level on our overall bottom line with this online retailer. So there is certainly still a very strong grip on profitability in 2025. But we now have to set that a little bit into the context on what has happened, particularly in the US, with US tariffs incoming and a lot of brands obviously being pressured to raise their prices and pass on their cost increases onto end shoppers and to retailers like Amazon. And Amazon is still with roughly 60 to 70% exposed in its overall net sales in the US market. So the question here really becomes, how is Amazon going to enter 2026, where a lot of the economic factors are still unknown? And I would say to this that particularly in the US, Amazon is currently panicking to a certain extent that sales growth and particularly volume growth will slow down. And we see a couple of indicators for this, such as the prolonged Prime Day, where they extended it from 2 to 4 days and now rectified this with the Prime Big Deal days back to 2 days because they were actually seeing that they couldn't capture all of the demand they wanted as part of this Prime Day event. But interestingly, for all of our listeners in the European markets, so UK and European mainland, I think we're actually going to see Amazon having to balance its approach away from a pure profit focus, more towards, again, a balanced growth and profit focus, right? Where they want to grow profitably, but where they also will have to convince brands to continue their investments into retail media, price promotions, and trade investments going forward, because the whole market will struggle from an overall sales growth perspective, and thereby the relevance of Europe as a second largest region for Amazon retail will become quite significant in order to ensure that they are going to see sustained growth in 2026 and beyond. So this is for all of the listeners kind of good news, but still the profitability hand grip will still be there to a certain extent.
I mean, maybe let's do a step back on like historical things, or like what we are really talking about is like we are talking about the AVN, annual vendor negotiation. So if you are a vendor at Amazon, you have to go every year in Q4, maybe in Q1, to vendor negotiations, right? Where they come to you and say like, hey, we want to have more profitability. These were your last year's results. And then your negotiation is starting, right? And every year, as you said, they are focusing on a different number, yeah. This is what what my experience was back then when I was a vendor manager and sat on this table of Amazon, like telling them like, hey, I got last year XYZ profitability more, and this year I want even more. Thank you for last year. And to be very honest, for me, that was the reason to leave Amazon, because I was like, okay, hey, where's the end of this? Always trying to get more and more and more, but
Squeezing the lemon.
yes, squeezing the lemon out, because the bitterness is like, ugh. And where's the end, right? I mean, I think, or my belief is that if you are having like a partnership, or if you are selling something, if you have a business partnership, then it should be at the end a win-win. It should not be like I squeeze my partner out and out and out, and then there's nothing on the bottom line left. So yeah, that's my personal opinion on that one.
And I hear you on this, right?
Yeah,
I mean, what I always say is
still true, right? I mean, this is like still the story they are doing every year. Last year, I don't know what was the main negotiation, because they usually have like one big thing a year which they want to negotiate, right? Or which they focus on.
So interestingly, it was not related to really a new initiative or new initiatives, but most of the accretive and incremental dollars and trade investment actually went into higher basic rules. So think of automated marketing, co-op, MDF agreements, followed by the Amazon vendor service. So 43% of brands said, okay, more investment went into higher basic rules. 26% of brands indicated it would go into the AVS. And then another 26% said into payment terms. So longer payment cycles for Amazon, improving its overall free cash flow. And I think this already goes to show, right? I mean, Amazon remains focused on moving the goalpost higher and higher when it comes to its net PPM targets.
Yeah.
And I always also tell my clients, it is on you to define where the absolute investment ceiling is. For some, it is at a total cost to serve of 35 to 40%. But I regularly work with brands who have a 60% total cost to serve. And that just means that for every dollar they make, they need to invest 60 dollar cents in order to even earn that dollar of revenue, which quickly can become quite destructive to their overall bottom line.
I'd like to come back to what you said at the end, that things are looking a bit up in the European market, especially if you compare it to the situation in the US. Why do you think that is? Why is Amazon going easier-ish on the European brands than it goes on the American ones?
The American brands are currently having the challenge that Amazon has followed and pursued a strategy of not necessarily accepting any cost price increases that were due to the introduced tariffs by the US government. So that means that a lot of these negotiations are still hanging in the air. And a lot of particularly mid-market and larger brands will have to pursue them as part of their upcoming annual vendor negotiation cycle. So Amazon knows to a large extent that they will have to hold the fort, but very likely will have to make some concessions if they do not want to lose the volume growth and also the availability of products that otherwise are no longer feasible for brands to list on Amazon. So it's going to be a very strict, a very tough vendor negotiation. Now, European brands, on the other hand, do not necessarily have this dilemma, right? Because they can still source their products out of China into the European Union or into the UK and cannot play the card of, look, I actually have to deal with cost increases due to tariffs. Amazon will in fact use the reverse card here and say, because the US market is fairly restricted now, everything else is coming with larger volumes into Europe. So we would like to participate from these volume scale efficiencies that you're experiencing, mandating cost price decreases or even more trade investments, right? So without taking a glimpse too much into the future, this is very likely how Amazon will position itself for the 2026 negotiation cycle. So for anyone listening thinking, okay, great, Amazon has more pressure on top line, but they will not be asking for more investments. This is where this balanced approach between profitable growth for Amazon will become very relevant and not just growth at all costs.
So interesting, because I mean, even if they think, okay, we have like cost reductions in Europe, right? How? It also doesn't mean that the demand is growing in the same scale, right? So it's
and you have a recession going on in large parts of Europe. So growth is not easy to get here, or less easy to get than in the US at the moment, at least.
Absolutely. But on the flip side, Amazon is often still the kind of key customer that can deliver growth, right?
Yes, that's true.
They're utilizing this.
Yes.
So often brands that are actually sitting in this outperformer bucket, who's indicate that Amazon is growing ahead of the category average. Well, you would think when you look at it at a first glance, great, they're like in a very favorable position, which may be true up until it comes to a trade negotiation. When the online retailer Amazon then also can say, okay, great, if we are driving your total growth, well, then we would like to also have a larger share to participate and enable this growth going forward.
Yes.
And I think this is the big dilemma that a lot of even established fast-moving consumer goods brands and hardlines brands are facing right now.
Yeah.
So, what are the best arguments then? I mean, if I am a brand in Europe going into these negotiations, and I know that I'm in the middle of a recession and Amazon is still growing ahead of my category, what cards do I have?
It's a very loaded question for the reason that there is no one-size-fits-all strategy and there is no magic silver bullet. What I would always recommend to brands is to first really sit down and prepare and understand what are the cost drivers and what are the margin headwinds that are really unfolding in my joint P&L with this customer. And oftentimes we are still seeing brands being very lavish when it comes to their distribution strategy, distribution control. They kind of have a policy in place with which they would like to establish a selective distribution agreement. But once there is a sales target to be achieved by the end of the quarter, they hand over their goods to almost everyone who's willing to place a larger bulk order at whatever cost price discount that there is. And this is often the start of a dilemma that is then reflected on Amazon, because Amazon will, of course, match the price of any other retailer or even third-party seller that is then trying to get rid of this stock that they've just purchased as a discount, and will give part of this discount to the end shopper as a result, right? In order to kind of have an incentive. Because if you give your product to everyone, well, the only differentiating factor is the selling price at the end. So if you really want to drive your margins into a more sustainable direction, typically the conversation needs to be happening even outside of the Amazon team. When you look at your brand's wider distribution and selling strategy, both in the online and offline channel. And this is a very difficult and hard discussion to be had. Assuming this is off the table, which is, to be honest, for most of the brands when they're looking at it from a short-term perspective, right? I mean, it's incredibly critical that you educate your leadership teams around it, but realistically you'll not be able to restrict your distribution in a current time within a 12-month period. Then you will have to look at, okay, what are my other levers and how can I improve Amazon's margin without investing a single dollar more? Maybe I even need to take out investment dollars in order to sustain my brand going forward. And quickly, we're talking about strategies where you need to talk about your retail media investments, where you need to talk about your price promotional investments and start becoming a little bit smarter on how you're utilizing these investments in your favor to not only drive your gross margins and net margins, so your overall bottom line, but potentially to also make part of the total investments eligible for your vendor negotiation. Now, we all know vendor managers throw their hands up in the air and say, okay, I don't care about your retail media investment. That's not part of my P&L. But what if you would say, let's use 10 or 15% of this retail media investment, and I commit to spending it against products that are not only informed by my brand and marketing targets, but potentially also through a layer of commercial targets, meaning that I'll spend it against products that have a slight net PPM accretive, so profitable position. And thereby I can help you get closer to a joint margin target and get products out of, for example, a delisting risk or a crapping bucket because I elevate the overall profitability of the account. It's an easy answer with a very complex execution because, again, you need to convince your internal stakeholders and your brand and marketing teams will not necessarily like it. But if you do not have any cards beyond that, well, you will have to look at this. The other element is to look at differentiating your assortment, or also to delist certain products that are so structurally unprofitable that they neither make sense to maintain on the virtual shelf for you or for Amazon, and hopefully also don't have a significant strategic relevance, so that you again can at least stabilize your account margins.
Yeah. And I mean, you really have to answer yourself the questions in more midterm than short term. How much dependent you want to be on Amazon, right? Especially if you're like this overperformer, you think like, oh yeah, great, as you said. And then you're sitting there in this AVN negotiations and you think like, maybe that was not the cleverest move, right? So also, and this is also outside of your own team usual, okay, where are other marketplaces where we can sell our products, right? I mean, or can I also sell on Amazon itself being a seller? Because right now we're just talking about vendor management. So we sell the bulk order to Amazon and they take care of everything. I call it also sometimes sell and forget, yeah, because you don't have to take care about so many things compared if you are a seller at Amazon. What do you think about the hybrid model, vendor, seller in combination? Is this a thing you can also use in AVN negotiations, or is it still a thing you do like more in a hiding way with Amazon? So how is this these days?
Yeah, it's a great question. I think, look, you can utilize it as a commercial leverage in your AVNs up to a certain point. And I think this is a point that I really want to hammer home here, because I see a lot of brands, particularly in the mid-market segment, falling the trap of a lot of propagated viewpoints of agency and service providers online who make a living of course, trying to move you over to 3P, to Seller Central, but do not have to deal with the consequences that you as a brand will face if you're listing half of your existing assortment and transitioning it from vendor to Seller Central. Now, it is absolutely true that you should ideally have a backup plan. And a hybrid model can certainly do that, because also just from a business and commercial best practice point of view, diversification will always be a benefit for your overall brand.
Yeah, and who
We've
knows
seen
when
this
the
with
next
the termination
cleanup
of
is
last
coming
year.
along. So yeah.
No, well, it's actually not the cleanup which is often a problem, because what I realized, the bigger the brand, the more important the brand, the faster the escalation road within Amazon. And I saw even big brands stopped selling from Amazon because they didn't got through their AVN how they wanted it. So I don't say that it is like correct or nice or whatever, but I saw these things happening, and then you think like, I'm a big brand, they won't do this to me. Maybe they will, right? I mean,
yeah, exactly. So having the option is certainly key. But the execution needs to be still considered through the greater framework that you want to succeed with the online retailer. Because I see a lot of brands saying, okay, great, let's just move half of my assortment over to 3P, not acknowledging that doing so will significantly stall their overall growth in the category for Amazon, and also half their top line sales that they make in the category with Amazon's vendor manager. Now, what you need to keep in mind is vendor managers will regularly look at how they attribute their resources. They're not growing in number. Actually, we're seeing a significant reduction in headcount in the Amazon retail team. So your vendor manager will spend most of their time on brands that are moving the needle in his or her category. So if you're halving your top line sales, and because you are anticipating a difficult negotiation, well, there is a risk that you will not even have a negotiation with a human being any longer, because this vendor manager will disassociate itself from your account, specifically if you're also not willing to invest into the Amazon vendor service, which has increasingly become mandatory to secure ownership and a linkage to a vendor manager.
Maybe
So you
explain
need to be
the
careful.
vendor service for just a second. So what does this entail?
So the AVS, or Amazon Vendor Service, is basically a support system for Amazon vendors in order to get an additional team of resources, usually represented through a customer success representative, otherwise known as brand specialist, to assist brands in the operational execution on their catalog updates or the onboarding to new supply chain programs that their vendor manager is unable to assist them with. So think of your vendor manager as the point of contact who will ensure that there is a commercial framework and they'll negotiate it with you, ensuring that the right margins are being achieved. Whereas then anything that is more executional is being handed over to the Amazon vendor service brand specialist.
Okay.
It's
like
a paid
your
service,
assistant within Amazon, right?
which is paid for, exactly. So
Well, you need
brands
to
need to
pay
actually
for
sign up to
even
it.
more if you have a assistant on your own company side.
Correct.
Yeah.
So a lot of brands shy away from it, right? Which is totally understandable.
Yeah.
But I would even say, like, if you pull back on any investment, it should not be your AVS, because if you kick out AVS out of your overall trade terms, you have a very high likelihood that your vendor manager will not renew the contract with you, so to say. So they will move you towards getting terminated if you're not growing in line with the category average, or if you're having significantly lower net PPM in their view. And if you're then moving products away from vendor to Seller Central, well, then this will kind of exaggerate the problem, and your vendor manager will have even less of a reason to maintain their resource on your account.
Okay, so what do I do to have a fallback version?
It's more about really thinking about, okay, what is the typical ASIN, so product profile, that is profitable on Vendor Central as compared to Seller Central? And we always think about the present business, right? So, okay, let's just move half of our SKUs over to Seller Central. But I would challenge this thought, right? Because you want to maintain your sales growth. You do not want to necessarily stall it. But I think we need to have the conversations in our organizations to say, if we are launching 100 new products going forward in 2026, we need to have a decision-making framework to understand from the get-go, is this product a good fit for Vendor Central, where we potentially want to utilize the supply chain initiatives this go-to-market model can offer us. So Amazon can even maybe ship it directly from China into its own warehouses? Or do I rather want to have full ownership over the inventory management and pricing side of things and be more flexible with my go-to-market strategy to bundle it in a larger pack size or pack format? Or do I want to test and learn with certain products? Then 3P Seller Central is usually the better alternative. Escaping your vendor negotiation through a hybrid approach rarely works for the foresaid reason, right? Because you increase oftentimes the burden for yourself to maintain the access to a vendor manager, but it can act as a short-term opportunity for you. If Amazon is adding any punitive measures as part of the vendor negotiation process on your account. So for example, if they stop ordering from you, if they do not accept your cost price increase, having a fallback option through Seller Central can keep the availability of the products in question up, effectively also securing the organic ranking of this product and thereby work as a fallback option. But again, it should be a short-term mechanism in the first place for your existing selection. It should not be a radical implemented strategy that then significantly jeopardizes your sales growth on vendor central side of things.
Looking a bit at the time, Martin, I'd like to close with something that I've been thinking about the whole time when you were talking, because it's, in a way, things don't seem to change that much. Yeah, Amazon is putting different focus on things sometimes, but still brands have to deal with them. Still brands have to give up more profitability to sell on Amazon. So same old in a way, but the world is not same old. Amazon is under huge attack from the various sides. It's being attacked by, I don't know, agentic commerce on the one hand, or by the Chinese platforms, by Temu and Shein and AliExpress and TikTok Shop, of course, as well, especially in Europe, actually. And they are still just acting the way they did a few years ago. Is that, I don't know, is that arrogance? Is that stubbornness? Is that they are just the best and they can still pick whoever they're going to working with? So what is happening here?
I think a lot of what we are seeing is incremental innovation, not disruptive innovation at this point in time. Where we're seeing Amazon being a little bit more disruptive is when we're shifting our attention more to the US market, which typically is a few years ahead of before these initiatives are coming over to the European Union as well as the UK. Two notable trends that I'm seeing that Amazon is certainly forwarding more or less successfully is on the grocery side of things, which may surprise some, because if you're looking at the recent news and updates, particularly in Europe, you're seeing that Amazon has concluded its Amazon online fresh shopping storefront and has sourced that out to a shop-in-shop experience. And now recently also shut down its Amazon UK fresh stores that are partially will be transformed into Whole Foods, but partially also being given up altogether. What's interesting, though, is when you read about what the follow-up action will be here. Amazon is planning to put a lot of the perishable, so fresh food selection directly into the Amazon.com as well as in the Amazon.co.uk experience, creating a more seamless customer experience for end shoppers to purchase all kinds of everyday products in the same channel without having the friction of signing up to a separate Amazon Fresh account or meeting certain minimum basket sizes, which seems to particularly work well in their private label range right now. So in the US, they launched, I think, a couple of weeks ago, their new private label called Amazon Grocery, which merges the previous very fractionalized private label brands such as Happy Belly under this kind of branded umbrella. And this has really kind of had a very strong growth trajectory over the last few months already and seems to really resonate with end shoppers. And just last week, they, on top of all of that, launched a new add to delivery feature, which now lets you as the Prime shopper add items to an already placed and completed order. So they seem to get a lot of things right, but they're very small nuanced changes that will add up over time and then also enable and position Amazon to have a much more fresh and fresh positioning in the grocery space. Where they, however, certainly fall behind, in my opinion, is particularly when you're looking at large language model based shopping agents. I mean, we've just heard OpenAI introducing their ChatGPT instant checkout experience, where Amazon today does not really have an answer to, right? Amazon has certainly launched Rufus, its AI shopping agent. but it really lacks a lot of the fundamental experience and excitement that I think shoppers would need in order to increasingly adopt this technology.
Yeah, it's just
And
reacting
so far,
in a
at
way,
least,
and not like
correct.
creating, but just reacting. Where it is reacting is what I found interesting. Again, US news here that they are now opening their logistics services to so many even direct competitors like Walmart. So what is that? Is that panic?
I think it's a repetition of the AWS and advertising business model, where Amazon has originally established very successful programs and now is starting to outsource and opening up these as really these central hubs for other brands to utilize. And especially the multi-channel fulfillment, or MCF, that you're referring to just now, is, I think, exactly the playbook that Amazon has executed with, for example, its cloud computing unit AWS, where they utilized first their own servers, saw they had excess capacity outside of the peak fourth quarter, and then offered it to other B2B companies like even a Netflix or a Zalando to take use of that. And I think with the multi-channel fulfillment, this will be the next kind of profitable play under CEO Andy Jassy, who wants to certainly showcase that the fulfillment capabilities that Amazon has on its own side also work for merchants that are utilizing the Shopifys, the TikTok shops of the world.
Yeah. And I mean, speaking about profitability in terms of like whole Amazon, AWS is still their main profitability cash cow. It's growing and growing and growing. And I can totally understand that they say like, okay, in logistics, they also invested so much money and they bought planes and trucks and I don't know, even ships, I think. So why shouldn't they use this as a next profitability hub? Because the retail business, it's not the main cash cow. I mean, I think it won't be in the near future.
Yeah, it certainly has improved. I think the mix of devices, transportation, and retail has been quite favorable for Amazon. So if you zoom out and you actually strip off the advertising and AWS revenue and operating income, you see that in the latest quarter, so it's the second quarter of 2025 as of now that Amazon has published, the retail and other bucket actually generated almost $3 billion in operating income. So all of these little nuances that Amazon has done and executed in the US, such as regionalizing its fulfillment centers, have certainly led to significant cost improvements. But you're absolutely right. It's not the highly profitable part of the business, particularly if you're looking at these low ASP categories such as grocery, beauty, health and personal care, which are accelerating at a fast pace in terms of volume growth on Amazon, but are highly unprofitable for them.
Yeah. Interesting. I think you could keep going and have a look at what Amazon is doing. And so I guess we will just have to invite you again to do another update, maybe in a year. But for today, our time is through. So thank you very much, Martin, for joining us today and sharing your insider perspectives on what's happening behind the scenes of Amazon Vendor, but not just Vendor, but everything Amazon. So thanks for being here.
Thanks you so much for having me.
Thank you so much, Martin. And if you enjoyed this episode, don't forget to subscribe to Let's Talk Marketplace on Spotify, Apple Podcasts, or YouTube. And you will find all links and Martin's latest insight in the show notes. And you can always visit us also on our website, marketplace-universe.com.
And so let's tune in again next week when we do another deep dive into the Marketplace universe. And for now, thank you for listening to us. And bye-bye.
Thank you, and have great vendor negotiations.
Yes. Good luck with that. Bye-bye.
Bye.
You listen to Let's Talk Marketplace,
the Marketplace podcast with Ingrid Lommer and Valerie Dichtel.